Hello, ladies and gentlemen, and welcome back. Well, we've got a very special episode because we're looking at over 70 years of data and the top 10 most correlated markets to current 2022 levels. We'll also be taking a look at what's in store ahead of the inflation figures. The market's running up as we expected, but is it about to find a hiccup? Up and then potentially down. We'll be talking about that in today's video as we cover everything to do with stocks, commodities, and cryptos right now. Well, welcome back everybody to the Daily Show where we talk about markets around the world. We'll start off with the macro data, then we'll go into the lead indicators, and of course, we'll end up with the key levels that we should be watching. Let's talk about smart money versus dumb money. So we've used this quite a lot this year, in particular when dumb money has overtaken smart money, has been close to the turning points. Now, interestingly, we've actually got something similar to what happened over here back in April, where dumb money came up and it just intersected with smart money dropping off. Right now, both technically are starting to weaken. So as they connect, this could be a very good time for us to start to look and be careful in these markets. I mean, that's been what's historically happened so far in 2022. What about correlations? What about when we start going back over the history? Well, here is the correlation with one of the markets that everyone's talking about, which is, of course, 2008 realistically, and that lead up into 2008. If we take 2021 January and we overlap it with the Sp500 from 2006 to 2009, you'll notice where we are right now. Basically, a very similar kind of level. We've made a new lower low, which happened here in 2008 and happened here in, of course, 2022, and we've currently spiked up, and of course we expect it to spike up there. Now, if you use this type of offset, you end up finding out that in the future comes the watershed moment. And this is what a lot of people have been worried about. Of course, if the inflation remains sticky, and this week we see inflation continue to be high or even, go up, the Fed has already said what it's going to do, raise rates. So this week is everything to these markets. And I think when we start looking at the correlation matrices, you'll see how many correlations do have potentially like these drop periods in them. Now there are 2007, 2008, obviously correlations. There's everywhere back all the way to 1970. You can pause the chart here if you wish to and have a look, or you can jump on over to @FXEvolution on Twitter and you can have a quick look at this image over there. But there's a lot of correlations that people like to look at. Generally speaking, one of the biggest ones right now has to be the 2008 one. I mean, it's very heavily correlated together. In fact, it's a 0.9 ratio. If we take all of these highest correlated years and we think about what happens next once we start to get these readings, from this point on, these are the readings. 1 week, 2 week, 1 month later, and even 2 months later, you'll notice it's not really that positive for the stock market. In fact, it's more kangaroo-ish, if not a little bit weaker. Some markets, of course, were dropping fairly significantly. Some readings here with 2008, some readings here with 2002, 2001, and it didn't really look too good. If we go through the top 5 correlated markets, the highest 5, that's when things change a little bit though. It in fact shows us that potentially we might have a little bit of a bumpy ride, but then 2 months and even 6 months later, 100% of the time, the most correlated markets were positive. So could this tell us that maybe we're starting to get close to the bottom, though we haven't seen that VIX plus 45 that we've been talking about? Well, it could certainly be so. Remember, if the markets do end up reacting heavily to some kind of inflation number and we get that watershed moment, they can be the opportunities where people that follow like maybe Buffett's advice, be greedy when others are fearful, potentially could be finding close to the bottom. It's probably not the bottom, but very close to. So what about economic recessions? What about the end? Well, the only reason I bring up recession as even a word is because once we know that we're in a recession, which we basically are, but of course they've changed the wording on it, we will end up knowing usually how close we are to the low. Remember, when recessions are technically called, we're usually already coming out of them on the stock market. We've had one of those big readings from unemployment, the first tick up for a little while in the unemployment figures. That's why next month, make sure you look at non-farm payrolls, because all of a sudden, this number will really matter. If we see a rise in unemployment again, and it's more significant, it could mark a very big influential turning point, because on the average 6.1 months before the recession is called, we tend to see these spike up. So all this data is starting to build a great case for when we potentially could be seeing the bottom. And right now, based on the internals in the market, there is some sickness there. And we'll talk about that later. Commodities are the only good thing, and potentially that could be stagflation. Put buying is still never ending. We'll look at options a little bit later on in today's video. We certainly need to be focused in on these options because there's too many of them. And once November is out of the way, once the big ones have expired, in fact, next week, the market could and potentially may lead into that capitulation. That's when the biggest options expire, all those puts, and it's free to go down if it wishes to. Remember, right now, it's incredibly expensive for the market makers to pay out a lot of those puts that are sitting in that 350, 360, and 340 on the SPY. Which sectors are doing best right now? This is the internals of the market. It's industrials, energy, staples, healthcare, financials. Are they what you expect to recover first in a market, let's say, pick up? No, they tend to be actually later. They will bounce initially, but we usually want to see discretionary and technology. They've been the lagging sectors in the recent weeks, and that's a warning sign to all of us. Conditional seasonality also doesn't look so good in bear market years with midterm elections or even without. We end up having these kind of pullbacks usually through November and potentially sideways kangaroos into the Christmas period. Again, that is different from the traditional incredible runs that we see through November into December in most years. And remember, November, December technically is a great time to own stocks. It just may not be in 2022. Earnings beat data is terrible, 62%, beats 1,077, misses 671. Again, earnings season is a disappointment. The market probably expected this, but again, the expectations are not that high. Some stocks are getting beaten, particularly hyper stocks. It seems like every hyper stock that is pretty much coming out and giving an announcement is getting sold in the market. Palantir got sold off fairly heavily after only opening down about 2%. We saw Twilio get absolutely bashed, CrowdStrike, so many others getting hit over the last couple of weeks. Walt Disney is now probably the biggest main earnings coming up here Tuesday after the close. And then we've got some other hyper stocks coming out later on, Rivian, Roblox, of course, Neo, and others. So be careful out there, guys. This is an incredibly volatile time for those markets. To just better illustrate what I want to say about the internals of the market being different is we need to look together at this. Look at energy. Energy's 13.1%, the best sector to be in over the last month. But behind it is a very strange one, industrials. Then we have financials. Then we have things like staples, materials, even biotech. Some of these sectors are the best performing. Now, what should you usually have performing if you're in a recovery? We generally should see technology, semiconductors, which has improved, don't get me wrong, consumer discretionary, communications, clean energy. All of these should be theoretically doing better. That's the new economy versus the old economy. And the old economy is absolutely smashing the new economy from a, let's say, recovery standpoint. It's not normal, though, to show the signs of a bottom in the market. Now, we could be wrong because, of course, inflation is the main concern right now, and we may be moving into stagflation, which we'll talk about, but it is interesting to see it. So what's happening with the VIX? Well, the VIX continues to fall down. It spiked through the Monday session, and then it ended up falling down 0.9%. So this is super interesting because, again, it's consistent with that read from previous periods. If we think about 2008, the most heavily correlated before the watershed moment, admittedly that was, of course, the Lehman Brothers moment here, we ended up having a VIX very low back at 20, the calm before the storm, as they call it, and then we saw a massive spike in volatility. Now, quite a few people are talking about this. Depends how many people. Sometimes if everyone's discussing it, it doesn't work that way. But in certain terms, you can say that we haven't had a VIX 45 plus, and that's unusual if we are to find a bottom. Generally, you will have a maximum fear component to flush out those final positions, and then that will allow the market then to potentially turn. Let's have a look at the US 2-year. The US 2-year continues to rise. Now, we're not back to where we were, but as we know, all eyes will be on this. The Fed, the inflation numbers, if that starts spiking up, we all know what usually happens with the stock market. It's not going to like it and should theoretically go down. Now, what I'm most interested in is what's happening here on the 10-year. The 10-year has actually started rising quite significantly over the last couple of days, up. Interesting. And also look at this flat line. So for anyone that doesn't know, we're going towards 5%. Basically, the Fed has already said, yeah, we're going to go higher than we initially expected. That was the big story last week, which sent these markets down. Now we're sitting at 5% in April of 2023. And by September, we're sitting at 5.09. So possibly even a new rate hike starting to get priced in there. And more importantly, there's basically no cut for the entire year. So that means that the market goes up and then sits for potentially 1 year in terms of what we're seeing from the forward rate. That is why I think commodities and specifically gold could be starting to find these huge buyers. A situation of potentially sticky inflation and therefore stagflation, what happened back in the 70s. Now, what were the two best performing sectors in that period of time? Gold was number one, and the second one was commodities. So I do think that when we had those low prices, what's happened is the market has started to think about going into those sectors. What do you guys think in the comments down below, though? Do you agree that's what's happening? I mean, obviously it's speculation because we don't know we're in that period, but it's a very interesting thing in the dynamics here in these markets. If we move over to high yield bonds, do they like the market? Well, they're kind of in lockstep with the market. They're not telling us anything. Previously, we've seen lower highs on high yield bonds while the market was making higher highs. That was a great warning. It told us, yes, we need to be careful. We probably need to look for shorts. If high yields go to a new low, well, we know what's happening. That's very weak. Same thing with corporate grades. Corporate grades are sitting basically flat. If they start to weaken, the market kind of sitting in a kangaroo style sideways, we know at least there's a great chance that the market will probably go down due to the bonds telling us that. Let's now move over to the US dollar. The US dollar dropped through a little bit of this first little demand zone I had, very basic demand here. We didn't quite see the turn point. We talked about this in the live stream. Join us every Monday for the live streams. And of course, if you're interested in more live streams, you can join our private community, 7-day free trial, and the links down below. And yeah, we've got the next demand zone kind of coming through here. Anywhere in here is theoretically potential for the DXY to buy up. But recently, it's been finding huge supply issues up here. So basically, the sellers have been coming in strongly here, and traditionally, the buyers have been coming in around these levels. So for the dollar index, I'm probably neutral on it at the moment. It's in a sideways action, and even if the dollar index does this, realistically, that could be good or bad for the stock market. It's a neutralized market. We're basically in a tight trading zone now. Traditionally, that's meant the market's gone up, but I would think that it's because money is flowing into some other stagflation style plays at this stage. Things like gold, things like commodities is where we're seeing it. Let's just have a quick look at copper. We can see the huge breakout that it had over the Friday session. That's now taken back a little bit of that, but we're still seeing it hold above these previous highs. So yeah, big move there. Huge copper plays in the last couple of weeks. If you look at the copper stocks, you'll see they've been going quite well. So if the dollar index is weakening, what's going to happen? Well, you'd probably think the euro will potentially strengthen. We haven't gone back into this supply that happened over here. So maybe the euro will find some legs and go up to those kind of levels there. Something to be looking at. If we go over to gold, gold theoretically should be weakening. It isn't, but it should be. The reason, it's got such a massive rally on it, and it probably needs to take a little bit of that off. Now, in the live stream in the previous session, we were talking about this. I was saying it should turn on that top end. It did for the session, but geez, I tell you what, it was pretty weak. It should have sold around here and then started to weaken and ideally move back underneath 1668, maybe find buyers right around in that 1662 zone. It hasn't sold off there yet. I wouldn't even mind it back in 1648. I mean, at this stage, what you're looking for in gold is pullbacks to potentially look for longs. And the main reason is from what the market's telling us. It's a 3-wick. I mean, 1, 2, 3. That's 3 big weekly buying demand zones. There must be something around that. And as you know, we also have the potential of, some kind of massive double bottom here or triple bottom. So if all of that occurs and we get, of course, big traders coming in, which I will be reporting. So make sure you subscribe to the channel and we'll check that out together. If we have big buyers buying into gold and they're consistent through a few weeks, this could be one of the better plays moving forward, especially if you believe stagflation's there. I mean, gold has been correlated with these particular periods. GDX is also showing the same type of thing. This is the stocks, obviously volume quite high here throughout this consolidation period. It's been pretty much one of the worst investments of 2022. Not the worst, but definitely one of the worst. And it started to, I guess you would say, stagnate or realistically accumulate now for quite a few months. So again, gold starting to look a little bit better, even if the market goes down. This is suddenly becoming, I think, a place where I can smell that potentially the street is thinking about that position. Let's talk about US oil. What's going on there? Well, US oil broke to a new high, took the high, and instantly rejected it. That's interesting. So we took the high. I mean, there's no doubt. Bang, straight through. Let's have a quick look on the crosshair so you can see it. There we go, new high. Now, if this comes up and it kind of does this, and specifically goes underneath here, you've got to watch out in oil. Now, oil does like high interest rates. So this week, I think it's going to just kind of sit around here waiting for the inflation numbers. If inflation goes off the scale up and then yields go up, what do you have to expect for oil? Well, oil will probably rise for that period. Now, if inflation comes down and interest rates go down, oil doesn't like that and should go down. They're very heavily correlated. So at the moment, we've seen interest rates going up on the long end. That's been pushing oil. And we have, of course, been following that kind of bullish thing. I'd be neutral on oil here to possibly even bearish around this area. But of course, the inflation number will end up reading it. Let's have a look at why the internals of the market look so sick. XLY versus XLP. This is the American consumer. Remember, that's 1/3. We are basically 1/3 of the US economy. We consume, we buy things. And what ends up happening is, yeah, we should see those stocks do well if the economy is healthy. Well, it doesn't look like it. We're about to make new lows on this indicator. That's telling us that the economy is kind of sick. And I want to bring this up just to do some critical thinking about this. If we load the SPX, that is the S&P 500 on top of this chart, what you'll notice is that generally when we're coming out of these horrible kind of dips, we're seeing XLY, XLP either leading the way or coming with it. And that's very important. When we start to see, heavy buying, usually we're seeing this correlate with it. Now, if we go back to 2008, you'll notice that XLY, XLP was actually early. So here's the new low on the S&P 500. But look, it didn't happen on XLY, XLP. In fact, this ratio was already making a higher low and starting to ramp off. So traditionally, we've usually seen, again over here, XLY versus XLP as a ratio find us the lows a little bit better than the rest of the market. And that's why it's important to have these types of correlation matrices. Think about markets this way, long shorts, ratios. I know a lot of you have been doing it. I've seen some of your shares. And if you've got shares, why not send them through to me on Twitter or on a Discord? And then we can share them with everybody out there. I mean, that's the whole point of this community, isn't it? So we can share these concepts. And I'm always willing to go through those ideas. Why not? Tesla, 197. Now it's broken to a new low, guys. That's not boding well for this stock. Now it's a bit disconnected from the rest of the market. Remember, Tesla hasn't seen PE compression anywhere near as much as some of the other stocks have. Recently, we've had Google, we've had Amazon, we've had even Apple. We've had obviously Microsoft and other big names seeing incredible compression of their price. Tesla's just broken to a new low. I'm still looking for the 180. I know the people in the chat that said, stop wishing 180 on this stock. I'm not wishing it. I'm just looking for it. If it happens, it happens. And if it does go down there, I do expect someone to probably come in. I expect it to swipe it and potentially some buyers to come back in. We've also got the thought process of this 120 to 140 range. I mean, for some Tesla buyers out there in the chat, maybe you're looking forward to that and you're thinking this is going to be the best opportunity ever. Maybe that's what you're thinking. But yeah, this is the level. So 180, I mean, we've broken to a new low. Even though we expect stocks to potentially have a little bit more of a ramp, and then we'll talk about soon, again, depending on this inflation number, this could seriously drop off. And if there's no buyers around this 180, well, there's nothing saving this stock until we go back and probably fill a gap somewhere around this 136. So we've got to keep those in mind when we're looking at this. It's not a good close for Tesla. Apple also waiting around demand, literally just seeing, I believe, what's happening here with the inflation numbers. We could see it just kind of hover here, even fall to a new low and sit around this point, potentially before the inflation number. It all comes down to that. It's a big bit of news this week. Now, what has been doing better is semiconductors, specifically things like NVIDIA, probably the best semiconductor stock in my opinion, or one of the best. And it's moving towards that first resistance point. We're getting close to filling the gap or the level that sits around this 144 zone. And I think that's going to be pretty pivotal. Again, that could correlate with the market reaching points we talk about soon, and then maybe some selling to come back in. If we get a new high, well, then that kind of changes potentially the way you look at these NVIDIA and other stocks. So big swipe at the low, similar to what we're hoping for on Tesla, a very interesting point. Let's have a look at the Dow. So Dow versus S&P 500, what's going on there? Well, it continues to plow up. And this just shows you again the old economy versus the new economy. It's old economy, you know, pulling everything. It's got nothing to do with tech and others. It's literally industrials, energy, healthcare, all of those types of things. So the Dow has made it back. Now I've got an alert above here. Remember, this was the trend line that allowed us to potentially short, or we did, in terms of the way we were looking at the S&P 500, the markets. Now all of a sudden the Dow's coming back. Somewhere around here is where you want that reaction to occur. You probably, if you're feeling bearish, you probably don't want a new Dow high. If that occurs, well, that could push, you know, S&P 500 as well. And then all of a sudden we're looking at what, that 4100 zone and the downward trend line for that, something to keep an eye on. If we move over to the US 100, you'll notice here it could still be double bottoming. A lot of people have said, well, what if we end up breaking through here and the S&P and something like the Nasdaq goes above? Yep, it's a very worthy consideration. I don't think we've seen the signs of that just yet, but yeah, I mean, we'll set an alert. Why wouldn't you? I mean, you're going to have an alert above here because that looks like a very nice base formation should it happen. Let's scroll into the 2-hour chart and have a look at what's going on right now, though. The market has broken out as we expected, but what if it stopped here and then it suddenly went down? This would all be part of a distribution that would be a trap, and this would be a trap breakout. If that occurs, you can react to that, and that's where we might see our watershed moment. So it's worthwhile considering this in the future and considering these lows because they're very, very key levels. Let's move over to the S&P 500. It's so far so good. It's actually rallying fairly well. We had that big daily kind of rejection thanks to the non-farms. Nice little rally here. We're looking for something to happen inside of these zones. These were all our original 3 supply areas that we expected the market to squeeze to. We got our first one, we sold off. Okay, cool. We so far haven't, of course, made to new highs, but at this point, because we sold off, we've got like highs and lows and higher highs and lower lows. You'd think there's some bear sellers moving forward very, very soon. Let's have a look at the futures action to get a bit of an idea here. So again, rallying. It's looking okay. We move into this area here. Previous selling, this was the Fed announcement, obviously, that sent the markets into shockwave. They went incredibly quick down. So it's coming back potentially to get fair value price. And potentially that's what it's looking for. Maybe the bears sit around here in these kind of zones. So I'm looking probably between here and here to see some reaction. I want to see whether the market can actually do a turn. And if it does do a turn, then where do we move towards? Well, I think that 36.77 is fairly key. Let's have a look at options to see if they agree with us. Well, this week is not very big in terms of options. We've got 1.1 million units. Yeah, it sounds like a lot, but most of them are sitting around 365 and 350. So that's where the puts sit this week. You can see there's not many calls or anything else. It's mostly put walls. Now we're sitting at the time of this recording at 380. Max Payne's at 378. I don't care about that so much. But that allows potentially at least 20 points down before even hitting the main walls, or 15 points down before hitting the main walls on these markets. If we move over to the 18th, you're going to see a huge increase. Look at this, 4.78 million. And look at the puts. They are stacked, guys. I feel kind of bad if these people still have 330s and 340 puts. They may not get paid out, probably won't. So look at all these. These are suddenly in the hundreds of thousands, and the 350. So there's actually, oh, there you go. So the 360 has been closed a bit. If I remember rightly, that was bigger when we looked at it in the previous session. So now we've got 355 puts being one of the biggest ones. Interesting. This is closed down. So Max Payne, yes, it's 380. That's going to change, but look at where the puts are. They're all sitting well underneath, or at least underneath the current market condition. So we could kangaroo round, we could come down. And as long as we don't necessarily close too far into these, there's still tons of money for the composite man, for Wall Street to make off these futures. And this is going to be the big thing. These options are very profitable should they let them all expire. After that, when you start going into the weeks after that, let's just have a quick look here. Look at this, 72,000 for that 21st. Let's look at the 25, 478. And all of a sudden, where are we? 330, 335. So what I'm saying here is, if we do expire, we start to see weakness. Imagine if all those options expire, where's the next puts? They sit heaps at 330, 325, 340. that's much lower than the current market conditions. It's interesting to have a look at these options chains. Definitely follow along, subscribe if you're interested in that type of stuff. So crypto is lackluster. I got to say, I don't like this market at the moment. I will like it. I just believe that we have to see a capitulation, pull through this crypto winter, and then hopefully move back into the good old times. Yeah, it's broken through the high. Theoretically, we should be moving towards 22,000. We've obviously got the alert under 20,000. If that happens, probably bearish here for crypto, and that could all be part of a very big bearish story. So again, with the stock market, it's the next kind of days that really matter here for crypto. If you're trading it, yeah, I mean, you're still theoretically long. There's no real reason to be bearish just yet on these higher timeframes, such as the daily and even the 2 hour. Yes, it's fallen down. Yes, it's looking weak, but we haven't got a break underneath that 20,000 again. So that's something we're looking at. For the week ahead, it's all about this one here, Thursday. But let's just quickly look. We've got congressional elections all day, Tuesday, 8th of November. Then we scroll down here and we've got the core inflation numbers coming out Thursday, November 10. That's going to be the big one. Still expected to be 8% consensus. That's pretty high, 0.5% increase. So obviously still thinking sticky inflation. If it's worse, it's going to be bad. Prelim UOM consumer sentiment, 10 a.m. here on the Friday. So that's the main big news. As you can see, bank holiday coming up as well. So we've got a lot of information coming through. It's really about Thursday this week, so we need to be aware of that information. If you haven't already, come and follow us over on Twitter at FX Evolution. Join our Discord. And of course, if you're interested in finding out more about what we do, you can always join one of our courses. I'd have to recommend at the moment our advanced scalping masterclass over at fxevolution.com. Just because, you know, I think it's one of the best classes we've ever put out, and there's a lot of great information in there that I think will blow quite a few of your minds. So if you're interested in finding out, you can jump on over. Otherwise, thanks for listening. Subscribe, smash that like button. We'll see you in the next one. Bye for now.